In this video, I'm going to give my views on Anexo Group PLC, and this is actually a paid request on my Fiverr. So if you'd like to request a stock analysis, please click the link in the description down below and you can request any stock that you'd like some commentary on. So I'm going to give a detailed stock analysis today and my overall views on the company. And if you like the video, please rate one of these to help beat the YouTube algorithm, as it is much appreciated. So first things first, Mark here decided to make the order on Anexo Group, and he had said that, can you please do a deep dive into a company I've owned a large amount in, as I've done a bunch of research into them over the past few years, but I'd like your take on them, to see if I'm missing anything now that obviously the beer bug years have passed. I'd like your take on their future growth over the next 3 to 5 years for this stock. So when we look at quickly the share price over the last 5 years, it has been relatively flat. Already we can identify here that this is a fairly recent IPO, and by recent I mean around about 2018. Since that time they've only really increased by about 14.22%. However, they had done very well before the pandemic in 2019, likely over rumours of a certain litigation or case, because I've still not described the business model just yet, and then obviously that spiked down during the pandemic crash. Now it's been very flat since, and it's likely because they are pending on one of these cases. But just so you know, Anexo is a specialized integrated credit hire and legal services group focusing on providing replacement vehicles to consumers who have been involved in a non-fault accident. So this is basically what they mean by this, is their clients that typically don't have options to access a replacement vehicle. This will give them a credit hire on the spot rather than spot hire rates, and this allows the charges from the at-fault insurer at no cost to the client. So effectively, they're being the middleman here. Money is going from obviously the no-fault client to the insurer, or the other direction, even in this case if they're at liability here. That goes that way. They've kind of come into the middle here. They're going to say, look, we're going to take a cut of this. We're going to offer you this to the customer or the client, and they're also going to take some of the money back from it. And a good way to see it is their business model down here. They show if there's a road traffic accident and there's a not at fault motorist, then there is direct capture sources. This is your body shops, your vehicle workshops, and your recovery agents. And you've also got the Anexo sales representatives. And then this moves into their credit hire, their bond turner page, which is one of their legal services and claim management, and then Anexo as well, which leads into their judgments or settlements. So speaking of one of their bigger cases, one of their bigger settlements, is the fact that they are in the midst of going against Volkswagen. Now in this RNS here, they mentioned that another subsidiary or another company that is not related to Anexo had seen their claim, I believe, gets put through, which means that it's likely that the claim that they've put through against Volkswagen is probably going to pass as well. And this was back due to their emissions, because Volkswagen, I can't remember the exact word for it, but they had a system in place so that it meant when they were going at a certain speed and at a certain distance in testing conditions, that it would lower their emissions by a significant amount. And it was actually found that in a different testing environment that these Volkswagen cars from a certain era were actually producing 40 times their legal amount of pollution. And because these cars were commanding such a premium due to the fact that they were meant to be cleaner and more efficient, this is where the claim comes in, where those that have either hired or leased a car from Volkswagen as also the ones that have bought it, therefore due some compensation in regards to this. Now, interestingly, on tip ranks, there isn't actually any analyst price targets or forecasts on this stock. Now, this might not be that there are no analysts that are aware of this stock. It just might be that they're not on the radar of tip ranks, meaning that only really small analysts have covered them. But that usually, in my eyes, is a green flag. The less analysts know about it, the more opportunity there is available. And in fact, this is backed up on Simply Wall Street, because if we go into Simply Wall Street and we look at the ownership of the company, you can see here that actually a majority of the ownership is by institutions, but not by an extremely savage amount, as well as the idea that they've got a 37.9% individual insider stake, and this is split between two people, Samantha Moss and Alan Sellers. Both of these share a very similar stake of around about 17% each. One of them is the managing director and of the board, and one of them is the executive chairman and chairman of the board. So they both hold similar stakes here, and I thought that was quite interesting. Notably as well, they do pay a dividend. The dividend is a 1.14% dividend yield, but it has remained flat for a very long time. Whilst, yes, they only pay a 9.1% payout ratio, meaning they've got plenty of room to grow if they should, I don't know if that's really the appropriate course of action. And in fact, I agree with the idea here that they haven't been pushing this dividend or trying to increase it that much, and instead focus on their own business model. But you will notice here that they have no free cash flows, and I will come back to that. So on the dividend here, we can see in the last 4 years, they've consistently paid a dividend of 1.5 pence. Now, this has been consistent for the last 4 years since they've been IPO'd. This is their only history available in which they've been paying a dividend. 4 years of the same payment is still promising. It shows that even during the Black Swan pandemic event, it meant that the company was able to continue pushing forward. And obviously in a situation like this where they're a credit hire legal firm specialist, they can do very well from it. Furthermore, when we look actually into their financial health, I'm not the biggest fan of their balance sheet. Whilst, yes, they've got rising equity over time and it's been a consistent increase, we've also seen quite a substantial increase in debt over this time period, where they've now got about a 40.8% debt to equity ratio and unfortunately quite limited cash of about £7.6 million. Now, we'll dive into this later, but this basically means that they have a net debt position of about £46 million, which when you've got a market capitalisation of £155 million, that is a bit of a concern there, as it says that 1/3 of the market cap is effectively debt and not something I would be looking for in a quality company. But when you look actually at their past performance, it has been very strong. They said that they had some difficulties during 2020, and it's certainly reflected in their profit margins as the year went on, although their revenue remained very consistent and continued growing in the midst of 2020 onwards into 2022. However, during this time period, we can see here that their profit margins have consistently decreased over time. So in 2015, they had a 27.8% profit margin. In 2019, they had a 21.1% profit margin, and now at the end of 2021, they've got a 16.2% profit margin. Furthermore, as we saw earlier, their free cash flow is negative. However, a company like this is not likely going to have predictable cash flow, and that's just due to the nature of their business model and the way they settle claims. Claims can take a few years to mature and finally realize their income. Therefore, they're going to have periods of inconsistent free cash flow. But it also means when you go back to the dividend information, that it's unlikely that it's going to be a consistent and stable dividend grower, as quite frankly, there's going to be years where they have cash flow and years where they do not. And so therefore, it would be a little bit of a concern. And so in that situation, I really would want to see a company like this hold a bit more cash. Although at the moment, it's not too high of a level, I would certainly like to see that one decrease over time. But again, I'm sure a lot of investors were also looking for that as well. So on their actual results here, their financial results that were released in May, we can see some good key performance indicators here. Now, I like key performance indicators because it shows you what the business thinks is valuable. And in this case, they have got new cases funded, or the number of new cases funded has increased by 36.2%, suggesting that they're reinvesting a lot of money back into the business and funding new cases so that they can make more money in the future. Furthermore, you can see that over the last year, their revenue has increased by about 36.3%. Their gross profit has increased by 34.6%, and this overall is a positive sign. Furthermore, they've said that the legal staff at the end of the period is now 22.4% higher than it was this time last year, suggesting that despite the considerable increase in headcount in their firm, they've actually managed to push revenue and gross profit at a faster pace, which is a promising sign to see. And they've got even more vehicles on hire, of about 21.1% on the year end, and that's quite a good positive sign as well. A lot of this is in my opinion, quite a bit of mumbo jumbo. Yes, I'm not really going to dive too much into this because I lack understanding. And for me, this is a company that I find very complex. I do not have advanced knowledge in the legal system and the claim system. Therefore, it would become difficult for me to really understand the business model on a deeper level. Now, I'm not going to just rule this out because of that, but it certainly would require a lot more research to therefore have an advantage over the common investor. And that's something that you should really consider when you're looking at a company such as Anexo Group PLC. They've also said in their current trading and outlook that they'd seen quite a struggle following or during 2020, but they are very happy with the growth that they have seen. They have now got a targeted approach which has led to the reduction on the number of vehicles on the road since the beginning of full year 2022 to a level which best facilitates management of the group's working capital requirements. That's good. They're tailoring to the working capital requirements, and if they keep those strategies or those requirements or targets in line, this could be positive for the long-term aspects of the company. But again, you need to dive deeper into this and work out, okay, what is the working capital requirements? Have they specified it on the 31-page report? However, the group remains focused on quality claims, high service standards, and high success rates. This to me seems like a lower risk business model. Sure, it's probably not going to be getting insane sorts of money coming from claims, but if they're focusing on the quality claims, the ones that really have some substance behind them, they're going for high service standards with this vehicle hiring and high success rates. They've pretty much nailed in a few good parts here, and the customer's happy, you're likely going to win the claim, and also with that high success and the quality, it's a promising sign for the business. It just means you aren't taking on low quality claims, and by that I mean someone that goes, yeah, I had a car, and with not much substance to back it up, and therefore it's riskier. Despite the lower initial cost and likely the higher cut they could take, it would be riskier over all. And they've said that whilst uncertainties remain in the given current environment, they continue to have great confidence in the strategy post beer bug and look forward to the future with continued optimism. So again, a positive sign, but they have also had some very positive language in their report, which might say, unlike some businesses that like to, over-deliver and undersay it. I can't remember the exact term, where they really under-promise and over-deliver. In this situation, maybe it's a middle ground. Maybe investors are used to this. But again, I'd have to read many years of financial reports to understand this language and really get behind what they're doing. But again, if you're researching a company like this and you're going to be in depth, you're going to be looking at multiple year spans. One thing I don't like is the fact of their layout of their financial statements. It's very, very annoying. And the fact it goes across multiple pages just suggests that maybe it wasn't tailored for PDF, but certainly their website, which I did actually prefer, to be fair. I think their website's got a better view on it. So we've got a better picture now of their total comprehensive income. Well, we'd seen that increase in revenue of about 36%. We can see on the screen here exactly how and why it's happened. So even though their revenue has increased by about 36%, their cost of sales has increased by about the same amount, if not a little bit more. Whilst, yes, it seems like it's a lower relative amount compared to the overall income figure, it is certainly increasing at an alarming rate, and that's likely what's eating into their margin, suggesting that as time goes on, it's going to cost them more to get these sales, but then we need to really work out how much money they're putting into this. And they did say that for their Volkswagen case, that they were putting in £4 million in marketing, and now I haven't got a source for this. I'm sure you'll be able to find it. So they're probably just adding a little bit more here. But again, this is cost of sales as well, which isn't going to be like your expenses and your marketing like that. This will be direct for sales, I think. Again, I'm not a qualified accountant. I'm still doing this learning. So if I'm wrong, please correct me. It'd be nice to see their gross percentage figures or the gross profit percentage figures to see how that's changed over the time. But again, I'm sure you could calculate that again by just doing it there. But I'd like to see a page at a glance, simplified data. And I'd like to see a 3-year time span as well to see how they were doing before the pandemic too. But in this case, they have done well during 2020. And so it's likely continuing to do well. They've had a little bit of an increase in depreciation, a little bit of an increase in amortization, but quite a substantial output or soar in their administrative expenses before share-based payments, was increased by about £13 million, which means that overall, when you take into factor financial costs, their profit before tax is about 23.7 million compared to about 15.5 million in 2020. And there, when you go down and break it down to the lowest level after tax, you can see about £19.1 million in earnings, which is a £7 million increase from what it was in 2020. So that's certainly impressive in my eyes. Now, the consolidated statement of financial position furthermore backs what we've been looking at the balance sheet before. We've seen a reduction in their overall cash position size, but not by a large amount. But the interesting thing here is we've seen quite a great uptick in their overall trade and other receivables. This is money that they are due to make, I believe. I need to double check this, but I think I'm right here. And so when they've got this amount and they've got this much that they expect to receive in income or other forms of income, or at least in cash value, I suppose, that is quite a jump upwards, where it's gone from about £148 million to about £188 million. So a promising sign to see, in my opinion. And there's been a pretty much a consistent uptick in their right of use assets, although their property, plant and equipment has actually decreased over this time. And surprisingly, I think in their liabilities, they've mentioned here as well. No, they haven't. Okay, I thought they had, but no. But you can see their liabilities of other interest-bearing loans and borrowings has increased by a substantial amount. And they did mention this at one point where they'd taken up more debt. I'm not sure if it's on the last page here. But they'd said that, yeah, we've taken up or secured a facility of about £7.5 million in credit, just so that they've got the access to the capital and available. And their retained earnings, so their overall earnings since the start or inception of this company, or since they started the reportings, is about £110 million, which, okay, is going to be quite useful to know, but retained earnings are not obviously going to be sitting in cash. It's likely going to be sat as value or equity into the business, although there would be some cash value, or at least something that they could use from that, aside from the £7.6 million in cash equivalents on the balance sheet. And then the cash flows from operating activities suggests that their amortization, as we've seen before, is picking up, but it's not a very high figure whatsoever. But their financial expenses are going up, and obviously taxation is going to increase as they're making more profits. That makes sense to me. me. And actually, when we look at the cash flows from investing activities here, you've got the acquisition of property, plant and equipment, which is a much higher figure than it was last time. They've spent about £1.4 million into that, which is why I was a little bit confused when we went upwards in that plant, property and equipment on the other table over here, that it actually decreased over this time. But again, this is something a little bit beyond my depth and very niche to be picking for this business. So with this business in mind, is this something I would personally buy? Well, I like the overall view of the company. I think they could be a good quality company, but it's certainly out of my area of knowledge and expertise. This is something that I wouldn't really dive into, even if they have got a very attractive price to earnings and price to sales ratio. And this is because I can't accurately predict or forecast their future growth. Because in my opinion, I don't know how likely some of these claims are to be settled. Whereas I can go to a McDonald's and I can see, well, there's more customers in here, and it seems like more and more people are aware of McDonald's, therefore more and more people are going to McDonald's to order food. And therefore, in my mind, it's a lot easier to understand. I can explain it to a 5-year-old and I can visualize in the future, okay, how does McDonald's grow? Well, they purchase more franchises, they purchase more land, they purchase more areas to put their stores up so that they're able to sell more food and put it in prime locations and expand across the world. Whereas with claims and that, I'm not entirely sure. What happens when these overall claims dry up? How can you always be finding these niche things that you can claim on? Will this always be available? Is it a long-term sustainable strategy of generating wealth? Well, I'm not entirely sure because, quite frankly, I'm not in this niche, nor do I have that advanced knowledge. So whilst at the moment revenue seems to be spiking upwards, although earnings remain flat, I couldn't really identify if that's going to increase over time, but the trend does look quite good, especially with the Volkswagen case hopefully coming out soon, and then their move on to Mercedes-Benz, which might be promising if there is some liability at fault there, which overall is good for the consumer and for the business. So they are offering value in both regards, but it's not really one for me, but again, a quality business in my opinion. So thank you for watching. Have a fantastic day.